Welcome to the latest edition of The Bull, the Bear, and You as we navigate what is happening in the economy and we take a look at investing. I'm Stacy Smith, and since you're watching or listening to this podcast, I ask that you hit the like or the subscribe button. Coming up, we're going to have a great discussion about crypto, also how to utilize the price-earnings ratio, a crack in the bond market, and the summer months. It's coming up in this edition of The Bull, the Bear, and You. And with me to talk about the economy and investing is my panel of financial advisors and experts, and they are Carrie Coghill of Coghill Investment Strategies in Pittsburgh, Frank Rossetti of HF Management Company, Kim Forrest of Boca Capital Partners, and Michael Godwin of Fergasso Advisors. I hope all of you are doing well. Looking forward to maybe some warmer weather this week, finally. Don't everybody speak at the same
weather.
time?
It's going to pretend it's summer for a while.
Yeah, I know. As you guys always know, I like to take a look at the numbers, and for the month of May, it was a solid month. The NASDAQ grew more than 9%. The S&P 500 is up by more than 6%. However, nothing is settled in regard to tariffs, so we could continue to see some big swings in the market. We are, though, now entering the month of June and entering the summer months. So, Michael, isn't June typically one of those calm months? And if it is a calm month, is that a good time, do you think, to really take a look at your portfolio, analyze what you have and don't have?
Well, as everybody here will say, it's always a good time to take a look at your portfolio and analyze what you have. But the crux of your question, I guess, I've never ever been a big believer in the whole seasonality thing in the markets, whether it's the Santa Claus rally, sell in May and go away, whatever you have. I mean, yeah. People say, the summer's beginning, nobody wants to work anymore. That's why there's calm in the market. I just have never been a believer in that. And I guess especially this time, Stacy, again, regardless of where you fall on the political spectrum, I couldn't care less. But I think we'd all probably agree that things are a little bit more lively, interesting under Trump than anything else, right? So you kind of never know what you might get here. So I think the tariffs and all the news there is going to keep a little bit of keep the markets on their toes. And I was actually looking this morning at the VIX, and the VIX is just a measure of the volatility in the markets, right? We are below right now our 5-year average in the VIX. So
really,
yeah, and significantly off where we were in April when the VIX spiked. It was the highest it had been since COVID, and we're now below the 5-year average there. So that doesn't really signal anything, but again. Now is probably not the time to get complacent, is sort of what I'm alluding to there. So again, the whole seasonality thing, sell in May, go away, Santa Claus rally, June's calm, I don't buy into that stuff. And always look at your portfolio. Always look at your portfolio.
Always look at it.
So I'll jump in here. I kind of sort of believe in seasonality, but not in, I'll agree with Michael that you should not sell in May and go away or any of those kind of programmatic ways of thinking. What I do think affects the market a lot, and I see it probably because I was a part-time trader at my old firm, so I had to enter trades. On days that precede a long holiday or a long weekend, there is far fewer market participants, and that adds to the daily volatility. So because there's so few people, if the bias to the market that day is up, it can go really high. And if the bias is down, it can go really low. And that's just because the markets need a certain amount of people trading in a certain way to kind of balance each other out. So watch, if you're going to place trades on those days right before a holiday, it's terrible. It's a terrible day to trade.
Let me clarify one thing before Carrie and Frank jump in, if that's all right. When I say always look at your portfolio, that's my job. I should always be looking at the portfolios here. As my clients, I always say, you don't need to do that. That's my job. If you're always looking at your portfolio as a client day in, day out, you're going to drive yourself mad based on what's going on in the market day in, day out. That is my job as a professional to do it. That's what I do. I don't need my clients calling me every 5 minutes when the market's up or down or yada, yada, yada. We're obviously taking care of it, and I know probably Carrie can probably say the same thing.
Yeah, I mean, that's why people hire us. One of the reasons why they hire us. And just to build on what Kim said, it is really true. I mean, part of our job is to understand when there is volatility, what is that volatility coming from? And the key measure that we look at, and it becomes more more of an issue over the summer is volume. We can look at the volume of the market as a whole. We can look at the volume of a stock to really get a sense for where's the market participation. And I think that's why we do sometimes see, as Kim said, before a holiday, but even kind of in August, like we paid attention to this a little bit more. It seems in August we have some variability with volume. And I also believe that, when you look at actually what month is most volatile, it's typically September. And I kind of feel like, because volumes can wane towards the end of summer, after Labor Day, everyone's back, and now all of a sudden you kind of get a clearer picture of where the markets or where sentiment is anyway. So volume is one of those factors, but as always, we're looking at fundamentals of a company. This type of volatility can actually give you some buying opportunities. So, always knowing what you own, what those names are, and knowing where your entry points would be if it's a position that you want to add.
No longer being available for hire. Going back to what Michael had to say about it's our job and Carrie and why people hire you all. They hire you to pay attention to things. And for those people out there that are do-it-yourselfers, the statistics show, and my experience shows, that people who try to do it themselves generally get whipsawed by all these cliches, I'll call them, buy in May. The Super Bowl theory, that's the one I love the best. And for those of you that don't know, they claim that if an old National Football League team wins the Super Bowl, the market will go up that year. Now, I want someone to explain to me what that has to do with, quite frankly, anything. All right, but that's a theory out there. And it used to be the May thing came because in the old days with qualified plans, with pension plans, corporations tended to throw their money in the first quarter because they had to. And they created a lot of buying that would bring it up to a little higher point at the end of April or so. So sell in May and go away because they're done putting their money in. That is less a factor today because 401ks take it over would have spread that flow of money into the system over the year a little more. So that's where that came from. It actually had value early in my career, no longer has much value.
Interesting. We've been doing this podcast now for a couple of years. And in the past, I think every one of you said that you were not ready to jump into crypto in any shape, manner, or form. There's a lot more talk now about crypto, including the president. So, Carrie, have you changed your mind at all about crypto?
Nope. So let me just back up for a minute. I think a lot of what we're hearing in the media you have to be able to distinguish between digital currency and crypto. They're kind of different, right? Like a digital currency is just a digital form of a currency, where cryptocurrency is more, like Bitcoin and so forth, things that are a lot harder to get our arms around because it's not really backed by anything. So the view that we've had on crypto, and it's not that we're never going to consider it, but when we're managing money for our clients, we have to be able to model, right? We have to be able to know what an asset class, what the tendency is. If interest rates go up, how is this investment going to perform? If we have inflation, how is this investment going to perform? We don't have those correlations established yet with crypto. I think initially people felt that crypto was going to be like gold, a good inflation hedge, or it would help to offset volatility. Well, we've not seen that play out yet. So until we can get some sort of correlation to market environment and other asset classes, we wouldn't be able to do our jobs in trying to secure our clients' future by going into an asset class that we don't understand how it will actually work under those conditions.
if you take gold as an indicator, gold has gone up quite a bit lately. There's a couple of reasons for that. There's probably many reasons, but there's two big ones in my mind. One is the dollar has gotten weaker, which means that gold trades in dollars, so it takes more dollars to buy the same amount of gold because the dollar got weaker. The other thing is due to political turmoil that's out there. If you're in Eastern Europe and you are a government official, I would bet you're accumulating some gold in some account somewhere else so that if you have to flee, you have some money when you get where you're going. I don't think crypto offers that opportunity. You can't carry it. It's not portable. It's not physical. So at this point, it's difficult. If you don't have a proper internet connection when you get where you're going, you can't get to it. So whereas gold, you can carry it theoretically, and because it's based on an ounce, it doesn't take a lot of ounces, which is portable, all right, so that you can have some money if you go somewhere. So,
Funny that you should bring. Oh,
go ahead.
funny that you should bring that up, Frank, about people buying gold in times of trouble in, we'll just say, less than stable governments. So, as somebody who the press calls me often for my opinion or whatever, in 2013 I started getting calls about cryptocurrency. And then again at the end of 2017 and 2018. And why? Because crypto was being bid up. Bitcoin went from this weird thing to it quadrupled or went 100 times higher. So people were interested in it. And then regular people started buying it, right? And that's how we have come to look at crypto now is Bitcoin. But anyhow, so what was the uniting factor between 2017-18 and 2013? It was that the Chinese government was cracking down on officials. And you cannot exchange yuan easily. And it's my strong belief that a lot of Chinese government officials were going to Macau, taking their yuan to the gambling houses, and then buying Bitcoin to get it out of the country. So that kind of gives you an idea on what Bitcoin is driven by. It's not supply and demand. It's not anything really tangible that, as Carrie points out, that you can model. The other thing is, I think we're at peak crypto. I take riding lessons, and the lady who teaches me is about in her mid-80s. And just this week, she asked me to explain crypto to her. That should tell you something. Like, how did she even know that crypto was there? I'll throw that out.
Kim, you ignorant. No, I'm kidding. You should have bought Bitcoin in 2013, though. Don't.
No, I should not. I'm sticking to my an asset class has to have something that makes it worth owning.
No, I couldn't agree more. I think that Frank brings the point home in terms of why these things are coming to play now. I mean, gold's up 30% this year or something like that. I mean, and the reason why Bitcoin's getting so much attention, I think, is just because of everybody's fear regarding the dollar and the U.S. debt. I mean, we eclipsed 100% debt to GDP a little while ago, almost a decade ago. But we're now at something like 120% of GDP. Our debt is that, and the big beautiful bill that might come to pass. Who knows what that's going to look like? It's going to continue to add to it, and I think we've been talking about the debt since we talked about this before, but since before I was born, it's been a quote unquote issue. So I think people are just looking for other alternatives than dollar, and gold's backed by the dollar, as you mentioned, Frank. I get all that. So I think one of the reasons why Bitcoin is becoming so popular and at $100,000 is because they want something different. But to Carrie's point, how do you value that? You can't value Bitcoin. I mean, who the heck knows what the true value should be? $100,000, $10,000, $50,000. Who knows? Zero, as Kim just pointed out with her hand there. You just don't know. So I always say if you want to own some Bitcoin, I have no problem with that. Make it a small allocation in your portfolio. If you want, take a flyer on it. Maybe it's an uncorrelated asset. We don't really know that yet. But as a viable, to Carrie's point, we can't model that. It's not going to go into our models now. But we try to help clients if they want to have small allocation to something like that, we can help you with it.
As I've said before, and I may be dead wrong on this, but it seems to me that crypto is supposed to replace our currency at some point, and it's still, you just said it, it's valued at $100,000. It's still being tied to the current currency that we have. I mean, that's the only way you can value it, I guess. So I don't know. All right.
Kim
go ahead.
once said, to just top this off, when IRS accepts crypto for taxes, she'll start taking it seriously.
I think, though, you are taxed on your Bitcoin. If you sell it.
In theory, you're taxed on the profit if they can.
Yes, that's what I mean. Yeah.
It's also, it lacks transparency. I don't know how they figure it out. I mean, there's a huge underworld use for this stuff because it's blind. The world is blind to who's doing it.
Yeah. Well, it's good. I think it's going to be around for a while. At least we'll talk about it. And I think Carrie's right. Once we get
The
an
underworld
idea.
will keep it around for a while. They're able to launder money without having a laundry.
Probably true. All right, let's move on here a little bit. The price earnings ratio, of course, is one of the key factors that advisors and analysts use to try to determine a stock's value. So, Kim, I will ask you, what is a good or a proper PE?
Gosh, this is the question for the ages. And being the true math modeler that I am, I've really looked at this. Now, you have to consider where I'm coming from. Consider the source, as my mother would have said. I started as a sell-side analyst working at a brokerage firm. So I was kind of the marketing department for software company stocks. And I was introduced at a time when it was 1999, so the dot-com bubble was there. And most of the companies that everybody wanted to own at the time had these really high price to earnings ratios. And sometimes they were infinite because there were no earnings or earnings were negative, right? So we can't have a zero divisor, it's NA. That being said, I take a nuanced view that there is no right boundary for this. What we're doing is we can use price to earnings ratio along with other ratios to compare stocks. And I think the most healthy thing to do is to compare it to its competitors. Why? Because their business functioning as a numerical analysis, like of their balance sheet, their income statement, they're going to be most like each other. So you can look at companies and say, am I willing to pay up for the potential growth for this? Or do I want to play something safer? And price to equity can show you that. So kind of a slower growing company, theoretically, should have a lower PE than a company that has less earnings and a higher price. That's what it's showing you. But as to, you used to be able to say, I'm never going to buy anything over 25 times its earnings. And I don't think that's healthy. I think you have to look on it sector by sector and then even subsector by sector to see if a company's overvalued according to its peers, not just the market and not just a number in space. I hope that helps.
It does for me.
Yeah, I would add to that, PEs are something that we look at all the time. And they can help in many ways. They can help to point out why something might be wrong or why the market's really excited about a company. So if a company, and to Kim's point, you have to look within the same sector because, margins matter and companies that have higher margins obviously are going to be more expensive. Generally. So if you know within a sector what that range of PE is, and you see a company that has a low PE in that grouping, that's not automatically a buy. To me, that says what's wrong with this company, right? And sometimes you can look and say, okay, well, they're restructuring, and I like the management team that's come in, and I'm gonna buy this. The other thing that we do a lot for companies that we know well, that we own, is that we're going to look at their PEs over certain periods of time. So right now, like for a tech company, because the industry has evolved so much, we're looking at a 5-year period. I want to know the range of the PE over the last 5 years, because if we do see a market sell off and now we see a good company that's trading on the lower end of its average 5 year, that might be exciting to me. For another company where the industry maybe hasn't changed, I might look at a 10-year average PE. So it really depends on the sector, and it depends on what the market environment has gone through. I want to see bull markets and bear markets. And, bear markets are pretty hard to come by. And COVID isn't necessarily a great gauge because it was so different. So, they're really important, but it's not an isolated number, as Kim said.
Frank or Michael?
I'll bet you Mike has something to say because Mike dives into numbers.
Yeah, well, thanks, Frank. But I'm going to take the opposite view. I'm going to take a 50,000-foot view on this because Carrie and Kim, everybody knows you get very nuanced with your thinking on this. If you just take a look at the PE ratio today of the S&P 500, we're at just under 22 times. And again, if you just look at the price to earnings ratio, we're higher today. The average over the last 10 years is about 18. So we're quote unquote overvalued compared to the average over the last 10 years. And there's a number of different reasons for that. I won't get into it. But if you just look at that, my synopsis on where we're going to be going over the next 10 years is returns over the next 10 years are just going to be lower than what they have been over the previous 10 years, based solely on that. Again, we can get more nuanced, I get it. But if you want to base it on that, I would say that over the next 10 years, you're not going to have the 11, 12% annualized returns. It'll probably be something more in the 7, 8% annualized return numbers for that. Again, Kim, I see you chomping at the bit there. Just kind of based on that, that's what your inclination is usually that you're starting at a higher starting point from a price to earnings ratio, your likely future returns are going to be lower than if you were starting at a lower price to earnings ratio in the market.
So maybe, I don't know, I don't believe in mean reversion. I know this is shocking. That's what you're talking about, is mean reversion, where something is higher and then it goes below the mean forever. So because tech has taken over the world and has just in general higher PEs, I don't think looking at these historical norms is all that meaningful, because I think NVIDIA has about 9% of the 8 or 9% of the S&P 500 weighting. So I'm looking at this from a purely math standpoint, and because maybe in the past 20 years, ExxonMobil, somebody that was an extremely heavy CapEx company that had to put a lot of money into the ground and had lower returns or lower margins, it's incomparable. So that's why I kind of disagree with you about mean reversion.
All right, I don't want to gang up on Kim, but I'm going to actually lean to the side of Michael. And let me tell you why. It might be for a different reason. One of the concerns, we look at how the market has gone up tremendously, over the last, 30 years, let's say. If you look at the demographic functions, so I have always felt that the market could support higher PEs because just supply and demand, right? You have a lot of people investing. We are going to be entering a time where the baby boomers now are going to be consuming. And so my concerns about, one of the things that we're trying to maneuver as we're looking at what expectations we have for the market, now those forces are going to be more of a headwind to the market as you have people needing to consume their investments to live. So I'm curious about the demographic influences that may affect the market over the next 10, 20 years.
There's no doubt from my experience that demographics probably is the largest driver to economic growth that exists. And it's purely a function of population growth and more consumption, which ultimately everything we talk about turns into what's being produced to be consumed by someone. And knowing that the developed world is shrinking in population, the ball of growth has to go to what is now the undeveloped world. And because the systems that fostered the growth we had in the 20th century are being changed. We moved through world wars towards globalization, true capitalism. We are currently, as a world, not just the United States, as a world, moving away from that model. And for the time, hopefully for the time being, and from my opinion, but if that's not the case, that is going to be a disincentive for growth. That's going to hold down growth as well. So it's going to be, as Mike said, very interesting to see what happens going forward in light of these potential systemic changes that are happening. They could turn on a dime at the next election. I don't know.
Yep, very true. All right, let's move on to one other thing here. This past week, J.P. Morgan CEO, J.P. Morgan Chase CEO, Jamie Dimon, again raised some warning flags about the bond market. He is predicting, he said over the weekend, a crack in the bond market. So, Frank, as the sage of this podcast, what does he mean, and is it of concern to the average investor?
I never use sage in my cooking. That being said, I haven't quite understood what a crack means. Bonds are pretty simple in my mind. They revolve around three basic things. As Kim likes to say, supply of money, in no particular order. What interest rates are doing, and what the credit quality is of the borrower. There's a whole lot of things happening right now that are, I don't know how new they are. I actually think they happened about 100 years ago as well, and that eventually turned out all right. The point is, we've got a lot of private equity taking place of banks. Got all these private loans, and they're making loans, and the question becomes, how good are they at credit evaluation? That's problem one. Problem two, the United States debt is growing. This is what got Jamie Dimon a burr under his saddle. He has determined that this national debt problem is going to create an issue, and he could very well be right. And then the third thing is how much money is needed. When I look at the world's infrastructure and the third world, which has virtually no infrastructure, there's going to be a lot of money to be spent on this stuff. Most of it will be borrowed. And that is, in itself is going to create demand for money, which is going to cause the price of money to rise, which is better known as interest rates. And consequently, and then we get down to how do you pay it back? Historically, the United States has not paid it back. They've just borrowed it from somebody else and gave it to the last guy, or borrowed it from him and gave it back to him. I mean, it's not unlike the person that has a house and constantly refinances it to maintain their standard of living. The bank, they pay off the old loan or add to it and create more debt. It's the grease of the world, and Jamie Dimon is concerned that it's out of control. Inflation will take care of that. It will cause GDP to go up more than the national debt. We'll see what the Senate does with the big beautiful bill, because they've got their chainsaws out right now.
The U.S. 10-year bond is yielding like 4.4% right now, which is higher than it's been over the past decade. We had 0% interest rates, COVID, all that fun stuff. But in the context of interest rates going back to the 70s, 60s, 50s, whatever, still pretty low. If the bond market, if there's a crack or whatever in the bond market, you will see a spike in interest rates because people are not going to want to hold our debt. We need to charge a higher yield to have people buy it, and that's it. So until that happens, I don't see too much of a problem with government bonds and whatnot. And to Frank's point, we can't default on our debt. We print our own currency. We will just print more money to pay our debt. But that obviously could beget inflation, which will drive the interest rates higher. But at some point, we do need to get a control on our government spending. And we've been talking about it again for 50 some years, kicking the can down the road. And I don't see this being a problem at all yet today meaning the next 5, 10, 15 years, but at some point, this will be a problem. Hopefully not in our kids' lifetimes or our grandkids' lifetimes, but we'll see.
Yeah. So it's really interesting. I think I might have mentioned last time that, there's a great Time magazine cover that has Uncle Sam saying, is the U.S. going broke? That was from the summer of 1972. So this is a problem that's been going on a really long time. And I think that's what Jamie Dimon is referring to. But to Mike's point, when the people that make the rules can change them, you can't bet against that. And that's the situation here. We'll just print more money, right? Or we'll figure something out, or we'll forgive some debt. Who knows? But I think it's a very complex situation to figure out. It's a complex world in terms of how currencies interrelate with one another. And, even the discussion about the US dollar being the reserve currency, I mean, that's not changing. We talk about it. We talk about it a lot. We've talked about it for my entire career. So, you have to watch it. But at the same time, it's hard to use that as your baseline thesis.
Kim, you have anything to say to wrap this up?
Really quick, I agree with absolutely everything everybody has said, but what I really want to talk about is looking at who's doing the talking, right? Because this is how you should look at as a market participant. As I told you, my mother always told me, consider the source. Who is talking and why are they talking? And who are they? So there's a lot of people like Jamie Dimon that he's a banker. He has been trained. His biggest job is to make sure money that he lends comes back. So by nature, he's going to see that glass as half empty. If somebody is wildly forecasting the future and everything is going to be great, I'll tell you, they're probably a tech analyst. And that's because they see the future. So what I want to do is make you a smarter participant in the market. And when anybody's talking on TV, on this program, you have to consider the source and say, what is their bias? All of us are going to talk what we really believe, because that's why we're here. But and the market has many participants. But whenever you hear somebody forecasting doom and gloom, I'm going to tell you, they're either a banker or a bond person. And if it's an equity person, ruh-roh, just take that into consideration when you're listening to the news. Who's talking and why are they talking?
All right. Good summation. Thank you. We will continue our look at the investing and the economy in future editions. And since you're watching or listening to this podcast right now, I ask that you hit the subscribe or the like button on whatever platform you happen to be using. Right now, thank you again for joining us, and we'll see you again next time for The Bull, the Bear, and You.